People always say that you have to have money to make money, and that there's an extraordinary level of sacrifice on the road to success. So how is it that investors like us, who didn't start out with much money and who don't rely on banks and credit, how is it that we can increase our income and build our wealth in a way that doesn't require us replacing one full-time job with another while still enjoying the things in life that matter most to us? That has always been the big question, and this podcast reveals the answers. I am Carrie Like, and this is the Investor Warrior.
All right. Can you hear me?
Yep.
How'd I do? I got
How he's operating the controls for the first time ever.
See right here.
Hey everybody, welcome to the Investor Warrior. It is June. Summer is here. The heat is on, and I'm trying to drive. I'm playing host today on the show with Carrie playing co-host because Carrie is off and around the countryside this summer, having what I've been calling the summer of love with the kids and having a great time and doing some serious camping. And she's been adventuring, which is, the great part about our business, right? Like we can do this, right? We can have these flexibilities, and Carrie is living the life right now. I'm holding down the fort.
I wouldn't say I'm living the life. I'm with my kids by myself, adventuring. Let's take that back.
Has it not been
Let's
good?
just call it what it is. It's been hard, but it's been really fun.
Yeah, it's been really fun. It seems like you've been doing really good. It's been amazing. I've been very, very proud of you. Carrie went on a 9-day. Was it 9-day?
12-day.
12-day camping trip up the coast, staying at camping sites like 2 nights, and cooking and the whole bit with her father. And I thought, man, something's going to go really wrong. And she pulled the whole thing off. It was amazing. So I'll congratulate you in public. How awesome that was.
Thank you. I appreciate that.
And then living the life of a jet setter. She came back down here for a few days with the kids, and now she's back up there. And then next week we go to Miami. And so it's a crazy summer. We're having a good time, and we are super excited to introduce our guest today, new friend by the name of Ryan Herting, who I got the privilege of spending some time with a couple of weeks back. He did a grand tour of Central Florida, and I think you met almost every investor there is to meet in Florida through the guidance of the great Candace Griffin, who we all know and love here, who put together your tour here. And Ryan, welcome to the show.
Thanks, Howie. Thanks, Carrie. Appreciate it.
Yeah, absolutely.
Ryan comes from a company that he co-founded called iFund Cities, and it's actually ifundcities.com. And I love that name. I think it's a fantastic. Just that name just kind of says it all. I'm big into branding and labels and things like that, and it's really hard to get it down. And I think that iFund Cities is just a fantastic brand name for you guys. How did it all start, Ryan?
Yeah, so appreciate the introduction. So iFund Cities came about. It's actually originally iFund Philly. So we're all from Philadelphia. Chris, Brian, and myself are the 3 partners here. We have kind of all different careers. So I'll give you kind of the background. Brian's got more of an institutional lending background. So he spent 17 years up in between New York and Philadelphia on Wall Street, kind of trading everything from mortgages. I call it the manufacturing process, from the origination all the way through the trade and servicing of a mortgage. Chris was a young kind of up and coming star in Philadelphia, working for a family office, doing a bunch of transactions in the residential space. That's kind of fix and flip all the way through small multifamily, this 20 unit and below space. And then I had done a bunch of private equity over my time in building sales and marketing organizations, and piled all my money into real estate. And so we built quite a few real estate projects from 2008 when we started all the way to current, where we still own and operate quite a bit of real estate in North Carolina, Virginia, and Philadelphia. And so we were lending to buddies. We ran out of deals to find. It got harder and harder and harder. And we were like, wow, maybe we can be the capital stack for guys that have great projects. And so we started lending as iFund Philly out of our own capital. We brought in Brian, and Brian brought us an institutional lens. And at the time, Philadelphia did not have an institutional lender, right? It had this kind of stodgy old bank space and really wealthy guys. really wealthy guys were really expensive. The banks were slow. There was no kind of intermediary for a little bit higher leverage, a little bit lower rate. And so that's what we brought. We landed in Philadelphia with an institutional model, and away we went.
That's fantastic. One of the things that you said there that I'd love to unpack for a second is, you're saying in your journey, deals were getting harder and harder to find. Tell me a little bit about that. Like, what was that experience for you? Because I think that a lot of us can resonate with that over the last few years, right?
Sure. So Philadelphia's gone through a renaissance, no different than what you're seeing kind of in Florida now in certain parts of it, right? And so it was this city stuck between New York City and Washington, D.C., with a lot of medicine and education as jobs, but it was a brain drain, meaning all the town here, Penn, Drexel, Villanova, Temple, et cetera, was leaving and going to D.C. and New York. And so what we saw was real estate developers really take a liking to different pockets of neighborhoods that had different personalities, and they would go in there and they would gentrify these neighborhoods. And so when we started, we could buy land for $8,000, $10,000. Those same lots today are $120,000, $150,000. So you add that increase on the land price for the demand, then you take in consideration your supply costs and your labor cost. And then you look at where the median income is and where wages are in Philadelphia, and the math starts to not make sense, right? In terms of the affordability of the product for the demographic in Philadelphia. And so something had to give. And so we fund a lot of guys that had land banked over the years, bought a lot of properties, sat on it, and now are starting to develop it. But it became harder and harder to buy projects.
Right. When you were here talking to all the investors here, did you hear similar stories?
Yeah, I did. Yeah. It seems like, especially the last 2 years, right? Like all of us Northeasterners invading your privacy down there in Florida. And I'm sure you guys are tired of us, but they're, it's running up the prices. So I heard a lot of investors say that margins are really skinny.
Yeah.
We see it on the lending side where guys are just doing projects just to keep their crews busy because they don't want to lose good teams that they built, but the margins are razor thin, or they may not even be making any money. They're just keeping them busy.
Yep. Yeah. We've totally seen that before.
Well, we've done that before.
It's funny. I was looking at Carrie. I was wondering if you
serious. Let's get real here. We've done that before, and we were like, why are we doing this? Why are we taking all this risk just to keep our guys busy? You know what I mean?
That's right.
Yeah. It is absolutely crazy. So, what's interesting about that to me is that it is very clear. I've been saying this for a while. I'm going to pull up for Sally right now. Like, I've been saying this for a while. Have I not, Carrie? Like, it's coming. It can't continue like this. Right. So I was very much involved in the crash of 2008 and the ensuing economy and that kind of a thing. I was caught up in it. I was fortunate in many ways. I was unfortunate in many ways, but I definitely was completely present to what took place during that. And, many of us, all of us that I've talked to that have had conversations over the last year around the comparison to that, the dynamics that were going on back then versus what has been going on recently, we all agree it's not the same thing, right? Like it's absolutely not the same thing. But there are some things that are consistent. Like when you look, like at some point, when you look at values, at some point when you look at prices, at some point when you look at the cost of a mortgage, even with the interest rates the way they were a few months ago, at some point you just can't afford it anymore. Right. At some point, the builders start going crazy because of the high demand, and we're gonna have a tipping point of inventory. Right. At some point, this crazy world that was created post COVID with the awash of cash, right, in the world, perhaps, and this is arguably driving, artificially driving up values in the marketplace and things like that. At some point, that's going to come to roost, right? Like, and what I've been saying is that at a macro level, winter's coming. I think at a micro level, different pockets have different dynamics, right? So what's going on in Philadelphia, and you probably became really present to this, Ryan, and I'd love to hear your thoughts on this. What's going on in Philadelphia right now is probably a lot different than what's going on in Central Florida right now, just because there aren't people piling into Philadelphia, but there are people still piling in.
Who wants to live in Philadelphia? I'm just kidding.
Everybody wants a cheap thing, guys.
Wait, I gotta stick up for Philadelphia. So I went there for my first time in my early 20s, and I remember being blown away by it. Like its history, the city's beauty. Like it is really, it is really, really a city that doesn't in our modern times doesn't get enough credit, right? Like it's a beautiful place. But let's face it, people are flocking towards sun and freedom, and and so so in a microclimate, people do expect the values to hold here, and they do expect that a lot of my colleagues still think the values are going to increase. I don't particularly think they're going to increase at anywhere near the rate that we've seen values increase in the last 24 months. I think we're going to really, really taper off. And I think there's some economies around the country, maybe like places where you're at, Ryan, that are going to actually really level off and sort of stick there for a while. What say you on that?
Yeah, so there's a ton to unpack there, and I'm not going to claim to be an economist, but I'll give you some.
No, feel free, unpack it all. I want to hear. You're such a sharp guy. I want to hear what you think about that.
So I'll give you Philadelphia. So Philadelphia proper, so Center City core, we lost 27,000 residents this year. So a lot of it's due to the political climate in the city, the crime in the city, and just people having it unaffordable. So we're out so far in fringe neighborhoods, tertiary neighborhoods from some of the core neighborhoods to buy a house that's affordable, that people don't want to live in those neighborhoods because they're concerned that the gentrification trend is no longer going to take place or be slower. So where they thought it might be a 2-year transition, it now might be a 5 to 10 year transition due to a lot of different things. We have a tax abatement that wore off. We have a political climate that's tough to operate for GCs and for builders and for developers, and so it's largely the most regressive taxes outside of San Francisco in the country.
I didn't realize that.
So that makes Philadelphia tough. That being said, in 2008 it dropped 18%, whereas markets like Florida, Arizona, Texas, some of these new age markets got clobbered 30-40%. So it is old. It's old established money. It's grounded on the right fundamentals of medicine and education that so far have not been decimated. So we're still bullish on Philadelphia. It's got a long way to go to be New York and DC. You're an hour from the coast. You're an hour by train to New York. You're an hour and a half to 2 hours to train to Washington, D.C., and it's got an international airport. So it's got a lot of the core fundamentals that you want. Good real estate market. So we're still bullish on that. Back to what you said. So the street so there's a couple differences between 2008, the largest being the demand, right? The demand and the supply. So the high demand, you got millennials buying their first time homes. They were in apartments in urban settings. Now COVID, they can work from home. They can live in South Carolina, Florida, Georgia, Texas, right? So you get this net migration south that if you look at the trends that U-Haul is a great trend indicator of one-way U-Hauls.
Oh, interesting.
That makes so much sense. I never even thought about that.
Yeah, so you can Google it for all you investors. You can Google it. You can see the metroplexes that are attracting people. And Florida's number 2, Texas is number 1, Tennessee's a big one, North Carolina, South Carolina, all your southeastern markets that are pro-business, a little bit more affordable, better weather, right? And so you have a better quality of life. We had a lack of inventory before COVID. And what COVID has done is sent supply chain shocks and labor costs through the roof, which only exacerbated that supply issue. So we think housing prices are going to hold. They're going to give a little bit because no one wants to pay 6.5% or 7% after the next hike for a 30-year mortgage. Yep. But we have no inventory. And so that's a huge difference from 2008 to today. So Wall Street is still bullish on this space of residential. And we see when we have builders building at volume that the hedge funds are buying these up at bulk. So it's less FHA, but it's more of these hedge funds buying up plots and plots of either land and or houses that are completed by the rent, by the builders doing build to rent. And so that's a good indication that there's a couple of things. One, if you're a landlord, you got to be scared because they're going to control the market dynamics. Hedge funds are, and residential real estate long term. But 2, it tells you that they have more data than all of us on this call will ever have. So they're telling you that residential housing is still a good place to put your money.
Can you explain a little bit? Like a lot of us don't really understand how the money really flows from the level of our transactions, right? So for instance, let's say I'm working with you and Candace on a couple potential projects to work together on. So we get that funded, we sign paperwork between us, that's go. But what most of us don't really understand is how that money flows upward. Can you walk through that? Because that has a lot to do with how that, like, it comes full circle, right? In terms of how it impacts the market. Could you walk through that for us, Ryan?
Yeah, so the tippy top of the spear is sovereign wealth money, some overseas capital, Bank of Japan, pension fund of Canada, right? So sovereign wealth and insurance companies are at the very tippy top of the spear, right? They have the lowest cost of capital, somewhere between 2 and 3%. They're maybe looking for a 5 to 6% hurdle.
Where would you put them in relation to the Fed, to borrowing money from the Fed?
So it's different on the institutional side. So I'm taking you over to the investment side of the thesis,
okay.
and
That's a distinction.
I'll take you back over to the Fed, and I'm not an expert on the traditional mortgage side. I spend most of my time on the institutional investing side. So I'm going to spend time where I fully understand it, and then I'll tell you some of the correlations between.
No, that's just really quick. That's a great distinction, because a lot of us don't really understand that distinction, number one. And number two, as investors, we're probably dealing more on the institutional side, and we don't even know it. So
the Fannie, I'll just real quick so the difference between Fannie, Freddie, and the institutional side is debt to income ratio. So looking at how much money you have on a W-2 or 1099 basis that's going to cover your debt service. That's your traditional mortgage, right? And they're looking at tax returns and the asset, but they really care about the individual credit, and they really care about how much income you have coming in to cover your debt service.
Right.
And depending on the amount of income, really depends on how many houses you can get on the traditional side without hitting their thresholds. And so if you're an astute investor and you want to start there, the best place to go is the Fannie Freddie's website and look at the guidelines, and they'll tell you the debt to income thresholds that you need for a primary versus an investor house versus a second home. Right. That's a great place to start if you have a W-2 and you want the lowest cost of capital. So
that's funny. If you have a W-2 is kind of a key issue there for us investors and business owners.
So if you don't have a W-2, you fall over on this DSCR, which is debt service coverage ratio. And that is basically the property cash flow and can it pay the debt service, your mortgage on that particular property, right? So I'm kind of
it's more asset-based than it is personally based.
They are going to look at your credit. They care about the DSCR. They care about the asset. They care about the market. They care about your real estate experience.
Yeah.
So we'll get into those underwriting criteria. So I want to go back to it. So insurance and pension funds at the top, they kick down to your private equity and hedge funds. That's your Blackstone. That's your KKR. That's your Apollo. That's all these types of guys, big, large institutions. They're private equity. If you don't know them, Google them. You'll see a litany of them. And those guys are really asset managers. So they're tasked with putting money to work in different buckets of money, or different segments of the market: stocks and bonds, commercial real estate, residential real estate, alternative investments, energy and power, etc. And so their job is to look at the playing field, look at the market, and say, what's the best risk-adjusted return in the market given where we're at in a market cycle? And those guys are the note buyers from guys like us who face off with the investor community. And they typically contract with guys that know real estate really well, have really good capital market experience, have infrastructure and processes. So unfortunately for the retail investor, unless you're a very big iBuyer, it's really hard for you to go talk to KKR, Blackstone, or Apollo. They're not going to talk to you. They're a group of 4 or 5 guys. You'd be shocked, running billions of dollars for that specific segment.
Wow.
So that's kind of how the money flows, right? And so what has happened is, so those guys buy a big block of real estate assets, and they do what they call securitization. And the simplest way to put this is think of big cake. They're making a cake, baking a cake, and then they're going to sell that cake in the form of a security to the pension funds and insurance companies. And right now, go ahead. Sorry. Right. Go ahead.
Oh, it's just the guys at the top. That's who they're going to sell.
Oh, yeah. So their job is to aggregate it, to get it all from the originators at the street level, put it into a cake, and then sell it to the big pension funds. What has happened lately is the coupon at which they used to buy at, which was 6.5% from originators, which is how you got institutional money on the street, anywhere from 7.99 to 8.5%, right? Because of the CPI print, there's been no consumer price index. So because of inflation, they're not going to hold bonds at 6.5% when the costs are 8.9 and growing, right?
Right, because they have to make money. They have to make the spread.
So what has happened is that cake's become undesirable. And so they're raising rates, the buy rates from originators like us, commensurate with the appetite for the inflation. So about 9.5 is what they're buying loans from. So what that means for the consumer is you're going to get paper on the street at 10.5% now.
Mm-hmm.
Which was in comparison 3 months ago was what?
6.5. You were getting paper anywhere from 7.5 to 8.5, right? Depending on your experience level, the asset, etc., your credit profile.
Right. So that is a huge jump.
Right. So that leads us to where we're going to go long term, in that does your project work at those new levels, or does your pricing of where you need to buy the asset need to come down to be commensurate with where rates are at and are going?
And this is where what you just said, this is where prices start to pull back. This is where the inflation of the real estate asset starts to slow down, because you just can't buy it any longer because it doesn't pencil out at that higher price. So now you have to offer less.
That's correct.
And that's how this comes full circle. That's why I see this starting to slow down.
Yeah. And you got first-time home buyers. You got to remember your first-time home buyers that would buy, if you two, Carrie and Howie, were building a single-family house in College Park that was $300, that's now $600. Mm-hmm. And that debt was at 3.25, and now all of a sudden it's at 6.25, and they're looking at their payment going, I can't afford that, right? Because people buy off the payment, and that's an unfortunate circumstance. So what they're going to do is back down that price. Maybe they can't buy it at 600, but maybe they can buy it at 540, right? And that's what I think you're going to see. The only challenge with that thesis is there's one house for sale in College Park.
Inventory, right? Inventory, yeah.
Right.
And and you still have a lot of cash buyers that are coming in, and the cash buyers are driving the prices up because they don't care. They don't have to go through appraisals. They can buy it for whatever they want to buy it at. And if there is a bidding war because the inventory is so low, it's the cash buyers that are coming in and offering what borrowers can't.
What do you know about the cash buyers, Ryan? Just that whole phenomenon that we've seen.
So in my experience is most of these cash buyers run out of cash. So they're either buying private money, they either borrow private money, or they got a finite amount of cash and they have to refinance at some point. So they're going to capitulate to the market. They can't buy in cash forever.
Right.
So I think that stops at some point. And I know we've seen a lot of bloated prices based on short-term rentals. And we've also watched them be decimated in markets like Charleston, which is one of the biggest STR markets in the country. And all of a sudden, Charleston banned them everywhere except for one.
Right.
STR stands for what now?
Short-term rental.
Oh, okay.
Yeah.
So I think it's an interesting.
Charleston banned all short-term rentals?
Besides one section of town. Yeah. If you go on Charleston's map for short-term rental, you'll see one sliver.
Is there any grandfathering that took place, or did they just wipe everybody out?
Yeah, the one section.
The one section.
Remain grandfathered. So we're seeing a ton of this, and it's unfortunate for investors because they're being duped, buying off cash flows that can change overnight, and it's a shame.
Well, and our lenders, I mean, so we've done a couple of short-term rentals. We've owned a couple of short-term rentals, and there was one where we refinanced it, and we did an asset-based lending loan, and the loan amount was based off of short-term rental rates. Mm-hmm. But it was weird because it was almost like the lender didn't really do much underwriting to see if we could even rent the house as a short-term rental. So for all they knew, we could be buying this based on short-term rental rates in an area that doesn't allow short-term rental.
Yeah, so I think a lot of
lenders gotten more strict with underwriting when it comes to short-term rental.
Yeah. So what happened last Thursday when the Fed increased rates 75 basis points was a lot of Wall Street stopped buying temporarily. They stopped buying paper from originators like us. So if you don't have strong relationships, what you had was brokers masquerading as lenders, and smaller lenders that don't have a balance sheet, don't have the ability to put loans on their balance sheet, which is a huge question you should be asking as an investor, are in trouble right now. They're on pause. And so iFund Cities, who has a pretty big balance sheet, is getting a ton of influx calls saying, hey, my lender suspended me 45 days because they're holding on to see if the Wall Street will start buying again. And the reason Wall Street's not buying is that cake that was really desirable is no longer really desirable in the securitizations, and they're not making money. And so they don't have the capacity to buy anymore because they got $1 billion on their balance sheet. They're going, until I can get rid of my layer cake, I can't go back and buy from Ryan and iFund Cities. And so
isn't that essentially cash drying up?
Yeah, liquidity drying up.
Yeah.
Now, Wall Street tends to be over dramatic, right? They tend to overthink it and pause right away. So we do think they will come back, right? So I don't think this is doom and gloom for all investors, right? But I think they are going to let the cake settle and figure out how they're going to make money when they securitize the cake before they go buying a lot of paper from other investors. Because literally the last 2 years, it was throw a dart if you're a lender or broker and they'll buy it.
Yeah.
Which is
So
a lot.
we underwrite for both long-term and short-term to make sure the deal works. And
Right.
the reason we do that is for the investor's sake, not only just for ours, because why would you want to buy a project that only works on STR, but God forbid something changes,
Right.
if you don't have a fallback plan, contingency plan, that's not a great investment for you and your family, especially it's where all your savings is.
Mm-hmm.
So investors don't want to hear that, but that's the truth, right? And so I think sometimes as investors, we have to sit back and go, does this deal really make sense? Am I being impetuous and impatient, especially in this market, or does the deal actually pencil
Right.
for itself?
You have a model that you've been working on that you call cap rate compression. It's involved, but I really would like to walk through it as slowly as we can without going too slow. I'd really like to walk through it and understand what it means, because the little bit that I've seen of it, it has a huge impact on us investors, especially those of us investors that have current projects going as do we right now. And how is this going to look, and how is this going to impact us as we go forward? Do you want to, for those of us that are watching us on video, I think you had a spreadsheet you can walk us through. It's a little bit of an eye chart, but we'll go through it slow and you can just get the idea.
Yeah, it's a little bit complicated, guys, so feel free to reach out to me and I can explain more. Let me give the thesis real quick, just so everybody understands. So we're now off of kind of residential and into what we call multifamily real estate, right? And so what we're looking at is guys who are mid-project that maybe underwrote their exit finance with a bank at a much lower interest rate than a bank can present today. And what is the impact of that to the project, and in particularly to the sponsor or developer who's working through that particular project. So that's what we're talking about. And it can be drastic depending on how the underwriting was done, especially for their LP investors, limited partner investors. They raised capital from other investors to buy the project and or own capital money.
Right. So if they syndicated.
Correct. So
Yeah.
I'll share this. It is complicated, guys, so feel free to tap.
So while you bring it up, let me see if I kind of have the use case here. So an investor who may or may not have syndicated has a project. It could be is this use case typically a construction to perm type of use case, or not necessarily?
Not necessarily. This could be more like a bridge loan where they're doing some value add, because a construction to perm may convert at a favorable rate. So guys that are in construction to perms may not get hit with this. Guys that are buying stabilized multifamily that may be overpaid a little bit in this market, who want to then go push rents and put in $1 to $2 million, and they got to go get bank financing on the end because they borrowed money from a bridge lender like iFund Cities. This is the use case that we're talking about.
Okay.
Which is the majority of guys, at least in our space, in the investor space, tend to buy quads, duplexes, this type of stuff. This is a little bit bigger project we're talking about. This is a 30 unit, but same.
And this could be the this is also would apply to the what's the acronym that everybody uses, Carrie, nowadays? Where you buy, fix, refinance, sell. What's the BRR?
The BRR.
Yeah, the BRR. Yeah. So this kind of flex to the BRR depending on which model you have, because if you've bought with short-term money, right, and you're looking to refi out to be, to get your short-term money down and to be in a better cash flow situation when you're done, I could see this applying to the BRR model as well.
Yep. All right, so there's a lot of noise on this. I'm gonna really try to simplify this. So let's just start with, can everybody see it?
Yep.
I got it up, and you'll walk. It's a little bit of an eye chart, but you can walk through it kind of piece by piece.
Yeah, so we'll start here, right? So everybody knows what the acquisition price is. In this case, it's $6 million.
Mm-hmm.
If we go down to the next cell, we're putting $2 million plus $2,366,000 in renovations into this particular building.
Okay.
Our closing costs for the lenders and all that stuff, soft costs is $270,000. So we have good. So we have a total. And feel free to jump in here. Total project cost of $8,636,000.
That's pretty straightforward.
That's acquisition plus renovation plus closing costs.
You got it. These three numbers. So just really simplified version. There's way more to it. Doing all this, but we're going to simplify it for today.
And that works.
And then we go over here and look at this debt coverage service ratio. So when guys are looking at how they're going to get out of a project, they're looking at what the lenders are going to require of them. And so one of them is this debt coverage service ratio. And it used to be like a 1.15, which means I could cover 100% of my debt and have 15%, the 1.5, in excess reserves over and above what my debt service is. Does that make sense?
It does. I think it does. Could the 15%, the 0.15 also represent net cash flow?
It could. I mean, your net cash flow is going to be how you determine that. So debt coverage service ratio is basically your cash flow divided by your debt service. So we're looking at the easiest way to do it. If you have $1,000 rent and you have a 115 expense ratio, you're going to get 1150. So that 150 is your cushion over and above your $1,000 mortgage, right?
That's a good one. Yeah, that makes sense.
Now they're looking at it and they want 1.25. So now they want 1250 on a $1,000 rent.
Mm-hmm.
Okay, so that increase. So they're going to look at this when they're buying a project and go, I know what the bank wants from me, or I know what the private lender wants from me, and they want to see that my debt coverage ratio is covered, plus I have a 25% cushion.
Mm-hmm.
The other thing they want to look at is this debt yield, right? And so these debt yields, which is your net operating income divided by your outstanding loan, right? And these ratios in multifamily, we're in the 7s. Now they're 8.5 to 10 that they want to see, right? So these are the two kind of key ratios that they look at. Then they come down here and go, okay, what's the current interest rate environment? So let's just assume for this example, the current interest rate environment when we started is 4.75 on a 30-year AM.
Right.
Solving for my debt coverage service ratio, right? So that's going to tell me what my end loan is going to be, which is this.
And in this case, for people that are just listening, the debt coverage service ratio was 1.25 on a 30-year and 4.75% interest rate.
You got it.
So this is
and the debt coverage and the debt yield is something that the lender is going to set.
Correct. Yeah. So their market, you can kind of, if you're a new investor, the best way to do this, call your institutional lenders, call your local banks, have conversation of, hey, I'm thinking about taking on a 30 unit. What do you need the debt yields to be? What DSCR, debt coverage service ratio, are you looking for on a multifamily building? Right. And call 10 or 12 lenders and get a barometer, right, of kind of where your market sits. Because each market's unique and each market has some differences, but there's some commonality across most of it.
And the higher the DCR, the less risk for the lender.
You got it. So in this case, they know from this loan that they're going to get their proceeds are going to be $6,160,000, right? So that's the supportable loan, which is a 71% loan to cost, right? Based on this deal.
Okay.
Here's where it gets interesting.
And real quick, this is loan to cost, not loan to present value.
Correct. Yeah. So a bank is going to lend off a cost basis,
Mm-hmm.
right? Which is what most multifamily exits. So Fannie, Freddie, small balance, CMBS, which is direct to Wall Street. Those guys are all going to, which is where most of the exit finance. They're gonna look at cost basis. Institutional lenders are going to go after an after repair value. So what's the stabilized value afterwards? And then depending on the seasoning, a lease up period will be what you get on a stabilized value. And so that's a whole nother section we could do on another podcast on how.
Yeah, it is. But you did a really good job because investors, we tend to get confused. Sometimes we're using different lingo too. And,
Sure.
the cost versus the ARV is different. right?
100%.
Because the ARV, if you're doing a good job, the ARV is going to be higher than the cost. But
ARV 1 to 4 is easy. ARV 4 up is challenging,
right
on the investor world.
Right. Mm-hmm.
That's good. That's good. Okay.
So here's where we get the sensitivity now. So we started at this 4.75. Well, holy moly, what happens if rates move to 5.25 during the project? So I got a 24.
That could never happen. That could never happen.
Never happens, right? They always go this way. I'm getting more money. I'm getting 3.75.
That hasn't happened. That hasn't happened in 20 years.
You got it. So it is happening, right, in the real world, and people are going, oh shit. So here's what's happening. So let's just say it went to 5.25. What does that mean? Well, it means my equity in the deal, which is the difference between this 8 million and this 6 million, which is this number over here, that's 2.46, right? That's what I have in the deal that I've either syndicated or put in myself or raised money, etc. Well, when my interest rate rises, when I go to do my exit finance, not only do I now get my 2.4 back, I got to come to the table with $340,000 more.
Let's. Did you follow that, Carrie? You want to break that down for a
Well,
second?
I just want to break it down for people who might not be looking at the spreadsheet. So basically what Ryan is talking about is the difference between the acquisition and the loan. So what you have into the deal, essentially. What our ultimate goal is as investors, right, is to refinance and get our money back out. But what he's saying is if the interest rates go up, when you go to refinance this, not only will you not get your money back out, you actually might have to bring money to the table. Is that correct?
100% correct.
Okay.
And so now we have an interest rate environment which didn't just go to 4.75, like we're closer to 5.75. And now Ryan, the developer, is going, oh shit, somehow I got to figure out how to get my 2.4 back so I can do more deals. On top of it, I got to go call capital for my investors or come out of my pocket as the general partner, $666,000 to pay back my initial loan that helped me renovate and add value to the project.
Yeah. And it's because you can't, with the higher interest rate, you're not getting the loan amount that you need to get.
Correct. Now, this can be offset by you have crazy rents, you have low expenses, you have a great market valuation. Like there's a lot of factors in here, but this is just something. The whole goal of this is not to scare people; it's to educate people that they really need to look at the sensitivity around interest rates when they're doing investments, not just what they think the market's going to be, not just what they think expense ratios are going to be, but really pay attention and test the thesis. Now, this isn't going to happen to everybody. Some guys bought deals right? But this is going to happen sometimes, and we've had a couple cases already. So this is solely for this tribe to really pay attention and test this model when they're doing their underwriting, because it's just another variable to consider.
And so just looking at this spreadsheet, basically, and this is, again, for people who aren't watching this and maybe you're listening to this on the podcast, is the spreadsheet is basically just giving you kind of a forecast on what your numbers are going to look like depending on what interest rate is available at the time of refinance, is how Ryan kind of has this laid out.
So, and then you can have assumptions, and we could share this with people. Of just here, current interest rate environments here. You know, your DSCR only works, at 4.5. So you may go back and go, listen, I got to buy this at 5.8. I got to buy this at 5.6. I got to buy this.
This is where the model really starts in the beginning, right? Because as investors, we make our money when we buy. we collect when we sell or when we hold or whatever, when we collect. But if it's not bought right, that's when we get into trouble. With a model like this, you can play the different scenarios and say, okay, look, I would be overpaying for this property in an environment where interest rates are going up. I have to make sure that when I get to the end of the 6-month project or whatever, that this will be right. And so that this will be a good buy. And that can be a factor of lowering the purchase price.
Correct. A lot of people go naturally to, I'm going to do less renovation. But I caution you on that because you really want to add value.
I'm laughing at that. I'm laughing at that because we're rehabbers, and I was like, we're rehabbing a big commercial building, in our town, and I was there yesterday, and you're like right away, you're like, where can I cut costs? As opposed to if I would have just bought this for less, right?
Yeah.
So
Well, I think if you went with a PDF of this to a seller and he's a long-term real estate investor, you go, look, man, this environment's crazy. I can't predict interest rates. They may be at 6 by the time it's over. You're a real estate guy. I want you to make money. And you understand his goals, but you also explain to him how this could really hurt you and jam you up. They're willing to have conversations, and then you can get into creative strategy. Maybe he holds the notes. Maybe he takes less and gets paid out over the course of a year. You can use this as a tool, negotiating tool, with the seller to have conversations about how you can creatively get the deal done if you feel that strongly about the deal.
Absolutely. Because you're bringing real data to the conversation. It's not emotion. It's real data. Here's what's going on. Here's what we have to consider. Right. It's not just me trying to whittle you down.
And a lot of these at least what we're seeing, a lot of these older landlords, which is most of the these small multifamily community, they're just tired because they got beat up during COVID. They got vacancies. People weren't paying their rents. They had to deal with deferred maintenance. And so they're really not solved. They don't really want this pot of gold because there's no place to put their money right now. So you can use this as a way to creatively structure, maybe give them cash flow, some money up front, money over 2-3, give them an annuity payout. We see really creative financiers use this spreadsheet to do those types of creative financing. And then come to guys like us. So I think that would be the takeaway. And then just pay attention to interest rates. I'd overstress it, right? Err on the side of caution. And if it still works after you try to kill the deal, then you got a good deal.
It's funny because for so long, that's just an area that we all took for granted for so many years because it was just so flat and low and just kind of figured that's the way it was going to stay forever. There's a name for that syndrome where we all think the way things are today are the way they're going to be forever. And COVID was a big wake up call about how things in the world can change, and right now is another wake up call, in the business world about how things can change, and so it is really, really a good lesson. I appreciate this conversation so much.
Yeah, and I'll leave you with a silver lining. The street does think that rates come down. They haven't given us a time frame. It's a year, 2 years, 3 years, but we all know that something like taxes would have to increase. There's going to have we're not going to be able to pay the debt service on this thing, right? If interest rates continue to rise as a function of GDP. And so I think rates will come down. So this is a short-term analysis that you need to pay attention to, but it's also the right way to think of as an investor, especially if you're going from residential into the multifamily space.
Yeah, absolutely. And this works in commercial as well. I've heard this a lot, Ryan, lately, actually from a couple of people that I really respect, that trust me, interest rates are going to come down by the end of the year. Like, I don't see it. Like, walk me through how that works. Like, what would drive?
I'm asking the same questions candidly, right? And the answer is no one really knows. Their long-term prediction is that rates will ultimately have to come in. That inflation is going to be somewhat transitory. Maybe it's the next 12, 14, 18, 24 months, but ultimately it has to settle down theoretically. So they say, and I'm not an economist, but then hopefully rates will subside with that. And ultimately we'll get back to an interest rate environment that's advantageous. It's not how I would play my game though, right? Like it works at current, and then all that's gravy if I could refinance at a later date, right?
Exactly. Because my personal experience, plus I think there's statistics to back this up, is that they go up quick and they come down slow.
Sure. Yeah.
Right. Just like the gas, right? The gas. Those of us have been through multiple things with gas. Like I'm old enough to go back to the 70s, and I remember the 80s and the higher interest. Like everything, like the gas always shoots up fast and just comes down. Even if on the other end, the gas is going down on the market end, it comes on the consumer end, it comes down much, much slower. And I feel like it's the same thing with the interest rates. Like they're not gonna come down as fast as they went up, unless I'm wrong. And if I'm wrong, what scenario would cause them to come back down as fast as they went up?
So the answer to that is I don't know. I don't want to bullshit anybody here. So I don't know all the inverse effects or what's going to affect interest rates in terms of currencies, foreign investment, inflation, et cetera. So the answer is I don't know. Right. So the best thing we can do as investors is stress test the portfolio, stress test the project to current environments with the forward looking that they get worse. And if they get better, then I have gravy, right? I have access to cash.
Exactly. Plan for worst case, and everything else is great. Yeah, absolutely.
And so I will leave you one last thing. I mean, look, as mortgage rates, traditional mortgage rates for first-time home buyers go higher, people are going to have a higher propensity to rent. So you're going to see rents increase. And so that's going to help cushion that gap of maybe what happens with interest rates, right? So, and then the lack of supply with new inventory coming on due to supply chain shocks and labor constraints are going to keep asset values high. So you do have some upward pressure that's going to solve some of that cushion, but just make sure you test the interest rate too.
That's awesome.
Does that make sense?
Yeah, no, it totally makes sense. Yeah, it totally makes sense. That was I don't know about you guys, but that was super enlightening for me. That whole process. And you, by the way, you promised me that you were going to send me that model, and so now I'm going to text you. I'm going to text you every 4 hours.
You don't know Howie. Howie gets really excited about spreadsheets. Like what you just showed him, he's going to be like playing with for the next. It's like going to be his toy.
It's funny. You know why though? This is
man in his spreadsheet.
There might be some listeners out there that can relate to this. So like Carrie as a great example, and a lot of other real estate professionals that I work with. Ash comes to mind, and Greg and stuff. Like these guys are fast with numbers. Like they're just boom, 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 boom. Carrie picked up on everything you said like that. That's why I asked her to recap it, because I go too slow. I'm not bad with numbers. I'm just not fast with them. And so, the reason I like spreadsheets is because they allow me to process them in sort of a slow moving way that my brain processes numbers. And so that's why I like them. Not to mention, it's a great memorializing tool, because I can then show it to someone like Carrie or to our investors or to our colleagues and coaches and just say, here's kind of what I'm seeing. Here's how I've processed it. And they can look at it and make heads or tails of it really fast and help with that analysis, right? So yeah, I do like my spreadsheet models, but it's because
I just tell Howie what's going on, and then he creates a spreadsheet for it. So he knows what he like understands it on the spreadsheet. I understand it in my head and all.
Right. And then she looks at all the work that I did, and she's like, "Why'd you go through all that trouble?" Because I got there like in 2 seconds.
Well, it's funny, Ryan, because when you said that spreadsheet was complicated, as soon as I looked at it, I was like, not compared to Howie's. I'm like, oh, this is easy.
I tried to keep it simple, stupid. I fall on Carrie's side. Conceptually, I want to understand it. Does the deal make sense?
Right. And you want to be able to play around with it easy enough so that you can take a look at all the different scenarios. I think sometimes when these spreadsheets get too complicated, there's too many numbers that you're changing. It just gets like too complicated to even analyze it from the spreadsheet.
Simple, stupid.
Yeah, I like it.
Yeah. So for those of you listening out there who are whose minds work as slow as mine, I'm with you. I got your back. Don't despair. We can do anything they can do.
Again.
So, Ryan, can you tell everybody how to get a hold of you? What's the best way to get a hold of you? Give them your handle. I'm sure there are people who would love to hear a little bit more about this model and about what you're doing. Because I mean, the fact of the matter is, you're still in the game, right? You're lending.
We are, yeah. So you can find us at ifundcities.com. It's the same handle on Instagram and Facebook. So ifundcities. And then you can reach me on my emails the best way, which is Ryan, RYAN, at ifundcities.com. Those are the best ways to get us. And we have a ton of these resources on our website, including our underwriting model. And so go look at the FAQs, the underwriting model. We put a closing checklist on there because we build a lot of houses. So everything we do with our GC before we cut the final check. So it's a wealth of knowledge in there from our experience of stepping on all the landmines you could possibly step on in real estate. So check it out and give us some feedback on what else you want to know.
And I will add to you guys, if you got a little bit confused when we were going through the spreadsheet because you were on podcast listening to it and you weren't seeing it visually, you can hop over either to our Facebook page or to our YouTube channel so you can see how Ryan actually shared his screen with us and went through that spreadsheet as we were analyzing that deal. So if you did get lost while you were listening to it, you can go over to the visual on YouTube and see it.
And I'll share it with Howie, so you can always hit Howie up and he'll get it.
Yeah.
By the time we hit Howie up, he'll have modified it. It will no longer be dumbed down. Trust me.
It'll have different colors and all kinds of stuff.
You're going to be like, what did you do to my
What
spreadsheet?
happened? Yeah.
All
Guys,
right.
thank you so much for having us, Howie. We appreciate it. Carrie, enjoy all your adventures out there in the wilderness. Lions and tigers and bears. And
Lions, tigers, and bears, baby. All right, Carrie, you want to take us out?
All right, you guys. Well, you're going to have to end us since you are the driver of the controls today. But we'll see you guys all in the next episode. And remember, you're only one deal away. Take care.